Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel L. Connon, and I have Garrett Cook here, sitting in for Dennis here during the 9 o'clock hour. Brendan, how you doing this morning?
I am well, thank you.
So you're the president and portfolio manager for direct lending. Before we go into that, can you give us a little bit of your working background and your education?
Sure. Graduated Brown in '95, was a management consultant after that. I found my way to becoming a turnaround CEO. Ultimately ended up retiring from firing people for a living, which was stressful, and decided to focus on my own portfolio. Found my way to direct lending and began first in peer-to-peer lending and then in small business lending to build my firm.
Okay, so tell us about your firm.
Sure. Direct Lending Investments is a general partner of a fund that makes short-term, high-yield small business loans. You can think of this as an evolution of peer-to-peer lending. Some of your listeners may be familiar with Lending Club or Prosper. Those are companies that make consumer loans. I've decided to focus on small business lending, a place where there's higher yields.
I got a question for you.
So higher yields, shorter durations. So you can think of small business loans as being one of the places where, because banks have pulled back and are doing significantly less small business lending, there's kind of alpha, this sort of broad range of economic opportunity for lenders who can participate in small business lending to make money. And what I do is identify those lenders that are going to be most successful, and the fund helps capitalize those lenders so that the investors can get very stable high yields. Last year, for example, audited returns were 12.4%. That's unleveraged.
Do you see the peer-to-peer lending? Is that gonna? Do you see this being something that could possibly, replace the format that we have right now with people putting savings into banks and then banks being the intermediary for the lending? Do you see that causing any problems to what's already established as far as the way that we lend money out now?
It's absolutely a change. What's interesting about it is that it's not exactly peer-to-peer lending anymore. In fact, what's happened is about 70% of the loans that are made by so-called peer-to-peer lenders are actually sold to institutional investors, insurance companies, folks like me. So in fact, when people think about what their portfolios look like, in many cases, if they have a 401k plan, if they're a member of a union, if they're in some kind of institutional investor, then they may actually already own peer-to-peer loans. What's fascinating is if you look at the rates that people pay on things like credit cards or on things like business loans, those rates haven't fallen in 20 years, despite the fact that the banks are borrowing money more and more cheaply. So we're talking about very, very inefficient credit markets. And when markets are inefficient, investors can make money. And so you have a situation in which people can put money in their savings account and earn 1%, or they can put money in short-duration small business loans and earn 12%. And the duration on my loans is less than a year, so there's no interest rate risk. It's really this extraordinary gap between the credit rates that banks pay and the credit rates that consumers and small businesses pay when they borrow.
So who are your clients, and how do they go about contacting you, and then what process do they go through for the loan?
Sure. So my clients are not small businesses. The small businesses that borrow money, whose loans I ultimately end up buying, will end up going through websites like Biz2Credit or QuarterSpot, IOU Central. This are sort of a broad range of small business lenders. It's my job to find the best of those and to help participate in their capital stack to provide them with money. So my clients are actually just end investors, and it's a huge variety of accredited investors. The fund's over $100 million. We have quite a few investors, and they range from mid-size RIAs to small institutional investors, high net worth, and there's really, other than being accredited, nothing special about them, other than the fact that they recognize that there is, in fact, this alpha in lending itself, so that rather than having to pick loans, they can just participate broadly in this phenomenon, this new type of lending phenomenon, and just simply reap the rewards of the fact that banks have been pulling back from this attractive space for almost 20 years.
You made an interesting point there that interest rates have really come down over the last few years, but really the rates on credit cards haven't. Will they ever?
What's interesting, one of the most common questions I get from investors are, well, what happens when your credit market becomes efficient and borrowers, small business borrowers, are paying less? And when I get that question, I usually point to the credit card market. And if you look at a graph of the federal funds rate, you can just see it plunging from 1980 to today, just like a straight line that goes right down almost to zero, in fact. And if you look at the rates that consumers have paid on credit cards during that time, it really hasn't budged. It's gone down from maybe 15% to about 13%. So the fact is that despite all of our intuitions, credit markets for small loans don't tend towards efficiency. And in fact, one of the things that's been fascinating about the relationship that I have with the lenders that I give money to is that in conversation with them, I'm often able to convince them that their rates are not high enough. And they're actually able to raise rates as a result of the relationship that I develop with them. So I don't actually think that consumers and small businesses are going to benefit. And there are a huge number of reasons for it, but the main one is just simply that there's a relatively small number of participants in these credit markets, and they have a strong vested interest in keeping rates high.
Okay, we got a question coming out of the chat here, and it's coming. It says, what types of assets secure these loans, and what percent of loan to asset value do you employ?
That's a great question. The thing that's attractive about consumer credit is that it's unsecured. And because it's unsecured, the yields are just much higher. And so if you look at what small businesses have become, 50 years ago, small businesses were manufacturing businesses. And if one of them defaulted on a loan, you could just go get their equipment and auction it off. What's happened now is that small businesses have become service businesses. And service businesses are asset poor. And so as a result, when we're getting rates like 25%, other types of numbers like that, when we loan to these businesses, it's partly because they're under collateralized. So what we file is a UCC1, so we have a lien against the business, and we'll get personal guarantees, but the underwriting is the key. You do not want to find yourself lending to businesses whose owners have bad personal credit, who aren't going to pay you back. We do actually file lawsuits against those businesses, and we always win the lawsuit. But it takes 12 to 18 months to do so, and you can't always collect. So the answer is, and this is something investors have to get comfortable with, have to learn to understand, is that it's actually unsecured businesses like unsecured consumers that actually make for the most attractive borrowers.
Interesting. So the fluctuations in interest rates, is that really, I mean, really not much of a fluctuation. They've gone down, and doesn't appear that they're ever going back up. Does that, if interest rates started to creep up, does this have a positive or negative effect on your business?
It's really irrelevant. And the reason is because the gross yield on the portfolio prior to default is about 23.3%. It really just doesn't make much difference if interest rates go up by 1% or down by 1%. And the average duration of my loan is 12 months. Most of my loans are $50,000 to $100,000 loans made to businesses that have been around for an average of 12 years. The borrowers have excellent personal credit, and these are one-year loans. They're actually repaid every single business day. 248 payments in a one-year loan via direct ACH transfer from the borrower. So this is a technology-driven loan. The underwriting is technology-driven, and it really just keeps its duration so short that interest rates are effectively irrelevant.
And how long has your company been around?
So we just celebrated our second anniversary, November 2012. We're participating in a stream of commerce that goes back to before the Great Recession. And so one of the things I talk about with investors, and I can demonstrate, is what the historical track record was for the companies that were lending this money. This was all happening prior to the birth of marketplace lending, prior to this model that encouraged the companies to sell loans to me instead of keeping them all for themselves.
Okay, and so really the Fed and everything that's going on in the economy. I mean, your loans are such short in duration; it doesn't really you're really kind of unaffected, but by what goes on. Just the moving on here, looking at your company, what are your future plans?
So right now we're operating as a Delaware limited partnership, what someone might think of as a hedge fund or a private fund. Ultimately, I think we'll end up creating some kind of a 40 Act vehicle, in other words, a mutual fund. And the plan is to grow from 100 million to $1 billion in assets over the course of the next few years. I continue to find really attractive opportunities, and I think that double-digit unlevered yield, while that may seem incredible to many investors who are used to thinking of credit as delivering effectively almost nothing in their portfolios, is completely possible here and will be, for some time to come. It's really just fascinating. People know that there's this gap between what they pay when they borrow and what they get when they invest, and yet they never sort of stop to really figure out how they can make the credit part of their portfolio work for them and how they can participate in all of that. And it's really peer-to-peer that got me focused on it. If it hadn't been for consumer portfolios that I was making 9 or 10% on, I would never have found my way to small business portfolios where I could make 11 or 12.
Okay, we've had Brendan Ross on the line, and he is president and portfolio manager for direct lending, coming on Benzinga's pre-market prep, brought to you by MarketFi. Brendan, thanks a lot for a look at your business. It's interesting to hear what you're doing, and we hope to speak to you again soon. Oh, one more question here. Do you charge points on each transaction or make your fees in another way?
So my fees are made simply by charging interest. The platforms that that make the loans, that I buy the loans from, those platforms may charge points, and those points will cover their marketing costs. It's important that people understand I'm not making loans. I'm buying loans that have been made that I'm evaluating and putting them into this $100 million portfolio. I thought I might leave with my website URL. It's www.dirlend.com, like direct lens.
Okay. All right. Thank you, Brendan. Have a good day, a good weekend, and we'll speak to you again soon.
Take care. Bye-bye.